Oh, good morning, everyone, and thanks for joining us on our SMSFs on the House webinar, which is a webinar about investing in property in your SMSF. And I would like to welcome my very special guest, my featured artist this morning, Ashleigh Goodchild from SoCo Realty.
Thanks for having me, Susan.
Thanks for joining us, Ashleigh. So this morning, we are going to be talking about investing in property in your SMSF. And I am wearing, this morning, I'm rocking our, I'll just see if you can see that, our Girls Just Want to Have Funds t-shirt, which is something that we've designed. So we'll kick it off. We're just waiting for a few people to join us. So I want to start off just giving my general disclaimer. So we are a SMSF accounting firm based in Perth. We specialise only in SMSFs. I hold a AFSL, an Australian Financial Service Licence, to provide all the advice around SMSFs. However, I do not give investment advice. And during this webinar, we will be providing general information. We will not be providing any specific advice or investment advice because we have not considered your specific circumstances or objectives. So that is our general disclaimer this morning. So if you hear anything, please do your own research and seek specific advice from a licensed advisor like myself, or for investment advice, please seek a licensed financial advisor. So let's kick it off. I also did want to mention I'm doing a series of webinars on different investment options for SMSFs that they can invest in. We did one recently on pink diamonds. This is the second in the series with Ashleigh on property. I did want to mention also, we just provide the information on different investment options. However, as an accounting firm, I'm very proud to say that from day one, we have never received $1 in commissions or referral fees. So we don't get anything from anyone that we refer anyone to. We just provide the information to our clients we just basically guide them through the compliance aspects. So I did want to mention that as well. So I just want to start out by introducing Ashleigh. So Ashleigh is a media commentator. She is a property expert. She is Perth Property's It Girl for property investment advice. She's often featured in media print, on TV. She is sought after for her advice on property. And I'm just going to go over to Ashleigh and introduce her and just ask her to explain what it is that a property manager does.
Thanks, Susan. I always feel so special when you intro me like that. You're one of the very few that does, so thank you. So my name's Ashleigh and I have been in real estate my whole adult life, so for 25 years, and I have owned my business, SoCo Realty, in the heart of South Perth for the last 20. Our office, we manage over 1,200 properties from Alkimos down to Mandurah. So my experience comes from managing quite a large volume of clients all over Perth, and also a real mix of different clients, whether they be interstate investors, local investors, accidental investors, or intentional investors. So there's a big range where my expertise comes from. So ultimately, a property manager is somebody that is managing your investment property for you. And every agent will be quite transactional in that they will look after the rental payments, finding you a tenant, handling your maintenance, arranging your lease renewals, and what I call transactional service, which is exactly the basis of all property managers around Australia. There's also a new trend with a different layer of property management coming through, which is really the helping investors create portfolios, helping them with areas, doing health checks, checking in annually with them, with how their portfolio is going. So I mention it because don't expect every property manager to do that. There are only sort of select property managers that actually do that next level, but definitely as an investor, what you should be expecting are definitely those transactional services. And it's really important. I mean, of course, I'm in the industry, so I'm going to say you should use a property manager, but someone likened it to, and I heard this quote and I really loved it. And they said, you wouldn't buy a $500,000 Lamborghini and then service it yourself. And it's exactly the same as a property manager. You know, you spend so much money on an investment property, you know, pay someone to look after it for you, as opposed to going down that road of thinking that, you know what, I can do it myself, because there's a lot of things that happen behind the scenes, a lot of legislation changes and a lot of things you've got to keep up to date with, that it's not something that I would recommend owners do themselves.
Wow. Yeah, no, that's amazing, Ashleigh. And Ashleigh, if you've seen her on social media, she is a very busy lady. The format for today's webinar, um, I am going to talk about the SMSF requirements. Ashleigh is going to talk about the property investment trends, and we're going to keep it to the 1 hour time frame because we do want to respect everyone's time who's jumped on here today. We want to finish off our part of the talk in 45 minutes, and we want to leave time for questions because the webinar I did previously, we did have quite a few questions. So if you do have a question, just pop it in the question and answer tab down the bottom, and we'll try and get to your question today. Also just to mention the scope of the presentation today, we won't be covering property developments because that's quite an advanced topic. And also we won't be getting into, we will be talking a lot about loans, but we won't be getting into the lending criteria because that's something that a mortgage broker would be talking about. I want to start off just setting the scene as far as an SMSF goes. Most of you will be aware that as far as your superannuation goes, you do have various options. So there's a lot of industry retail funds that you can have your superannuation in. And of course, a great option where you have a lot of control over your superannuation, you can roll it over into a self-managed super fund, an SMSF, and there you do have the ability to invest in a number of options. Now, property, of course, is a allowable investment, and we're going to be talking in detail about that today. Now, for an SMSF, there are a number of legislative requirements that you have to tick off. So to start with, we have what's called the SIS Act, the SIS Act, and the SIS regulations. And those two together, I'm going to refer to during this webinar as the super laws. Then we have what's called the sole purpose test. Now, the sole purpose test is the overriding test of everything you do in an SMSF. And it's basically that all the investments that you make, you have to show that you are providing for the retirement benefits of the members of the funds. So to give an example, in terms of property, a breach of the sole purpose test could be, for example, if you found a property that you very emotionally wanted to buy and you didn't have the funds to buy outside of super, and your plan was to, so you don't have the money to finance it, your plan was to use your super to buy that property with the intent that down the track you would take that money, take that property out of your super fund and you documented that intention, you talked about that intention, that could be seen as a breach of the sole purpose test. So your intent always has to be to provide for the retirement benefits of the members. You cannot have the intention to have any immediate benefit or any future benefit as a trustee or a member of the superannuation fund. So the next requirement we have to tick off is the trust deed. So the trust deed must allow you to invest in property. So a good trust deed will allow the investment in a property, and that's something that we will review for all of our clients. The next requirement is your investment strategy. So your investment strategy must cover off on the sole purpose test to allow you to invest in property. And it must also allow you or cover off on, your investment in property and how that it kind of, meets the, is a sound investment. And there's various things that you need to include in investment strategy. And that's something that you would require the expertise of an SMSF specialist like myself. Now, one other thing I wanted to mention is diversification. The ATO is very, very keen on diversification. In 2019, the ATO wrote to basically they selected anyone in an SMSF who had property with a loan where over 90% of the assets were invested in that property. And they basically said, hey, you're not diversified. And it did cause a great degree of angst within the SMSF community. Now, I would say on that point, the ATO, and it's written in various places on their website. I just read it again the other day when I was looking up something else. The ATO are not financial advisors. So the ATO cannot, in any circumstance, tell you what you can and cannot do, can and cannot invest in your SMSF. So you require an expert like myself just to document your decisions, and that will be sufficient. So you can invest more than 90% in property with a loan. The ATO can't tell you that you can't do it. You just need to document it appropriately, and someone like myself will assist you to do that. Do bear in mind that we have that old saying, don't put all your eggs in one basket. So if you have property, most people already, they'll have their residential house outside of property, outside of super, and then you're going to have property inside of your SMSF, and then you may or may not have an investment property. So it's a lot of property. So we do have to bear in mind, diversification issues with property when we're investing in property. Now I'm going to go back to Ashleigh. So one of the things that we've been noticing with SMSFs and investing, it does tend to go in cycles. What people are investing in, I've been doing this for a long time now, so it does go in cycles. So 3 years ago, the cash rate was very, very low. I had clients with $1 million and they couldn't get 0.1% in a cash rate in a term deposit. Now the cash rate, you can get 5% in a term deposit easily. When we went back 3 years ago, people had to put their investments in riskier investments to get a good return. That's not the case now. You can get a good return in a cash option. So the trend is that I'm finding is for people to go into very tangible assets. So for that reason, property is trending again. And also other tangible assets like gold and even pink diamonds, more fringe assets. So I would estimate 9 out of 10 of the SMSFs that we're setting up at the moment are investing in property, which was not the case 3 years ago. So I want to go back to Ashleigh and just ask her, Ashleigh, what are the trends that you are seeing in property at the moment?
Yeah, so I can't remember the exact stat, but there's a very interesting stat that says investors, don't quote me on this one, but it's like 90% of investors only actually have one property and 10% of investors have multiple. And I'm definitely seeing that change. There's a big movement for people to take advantage of the property and the rental market and buy lots of properties. And when I say lots, I'm referring to between 2 and 5 properties. So a lot of my clients have that plan. I want 2 to 5 properties and I want to maximize all of my lending, whether that's my personal lending, my partner's personal lending, then my self-managed super fund. And so there is, and we're even, seeing others sort of set up different company setups. So definitely a trend to maximize their investment portfolio as a whole, using everything they can. I am finding that the people that are looking at the self-managed super funds are the ones that have already purchased a couple of properties, and then they're again diversifying their portfolio by adding that on at the end. I'm not personally seeing people buying multiple properties in self-managed super funds, but definitely one. And I think what will happen is that this plan that clients have, they will stick with that probably for about 5 years. And then their personal properties that they've got, they'll probably tidy them up a little bit, sell one that they've done well on, consolidate some of that debt, and then aim to live mortgage free and aim to live with that passive cash flow, which is really a huge goal of a lot of my clients, and only something that I've seen in the last 3 or 4 years. I'm very much seeing intentional investing at the moment, where in the past it's always been accidental. So, accidental investing when, you've been inherited a property, or you have upgraded a property, and as life goes on, you go to the next bigger property and rent out your smaller one, that type of stuff. So yeah, a lot of intentional investing, definitely bigger portfolios being built, and definitely that diversifying with wherever they can get money from, including self-managed super funds.
Sure. And what sort of investment trends are you seeing in Perth and Interstate?
Sorry, that just glitched out a little bit, Susan.
Sorry. What sort of trends are you seeing in Perth and Interstate buyers?
Yeah, they are buying in lower socio areas. They did originally have minimum 700 square metre blocks. That has definitely reduced now to minimum 400. They are still wanting green title blocks. They have started looking now in Geraldton and Bunbury, because they, those that want that minimum 700 square metre block in that price range have had to go out. On average, I'm seeing budgets of around 550,000 to 600,000. That's the point that everyone wants to get in. If you are in Perth, you sort of have to get out into those suburbs now to get those price points. And then the trends that we're seeing with the self-managed super fund, of course, they're having to buy the decent property with the lower maintenance. So areas like Secret Harbour, Baldivis, dual key options down south, and then Tapping, Avonlea, and Alkimos going north. So definitely those areas are very quite specific with self-managed super fund clients.
Great. Thanks for those insights, Ashleigh. So we're going to talk a bit more specifically about the rules around SMSFs, just so that we can get some idea of what might be problematic when we're trying to buy property in an SMSF. So to start with, property, as I indicated earlier, is an allowable asset in an SMSF. So one of the main things that can trip us up in an SMSF are the related party rules. So one of the questions that I get asked the most is, can I live in the property or use it for my personal purposes? And the answer to that is maybe. So it just depends on the type of property and what you want to use it for. So when we're looking at the related party rules, they apply to acquiring property and also how we're using it. And how we're using it usually applies to leasing it or renting it. So it is important when we're dealing with property and SMSFs, it's very important to get it into the SMSF correctly at the very beginning because of these related party rules, because it's very difficult to move property into an SMSF subsequently because of these rules. So we'll go through them. So in the case of residential property, it's basically a hard no. So we cannot acquire residential property from a related party, and we cannot live in residential property that the SMSF owns. We can't lease it. No related parties can, so no relatives. We basically cannot do anything with it from a personal nature. So residential property, you have to basically buy something that's, completely on an arm's length basis, which just means that you are dealing with someone completely unrelated at market value, basically. Now, commercial property, which is just what most people understand, is different. There are some exceptions. Now, the true definition is not commercial property. The true definition is business real property. Business real property has two aspects. The first is you have to have an eligible interest in the real property. That just means you own it. So you own it. The second aspect is it has to be used wholly and exclusively in one or more businesses. So it doesn't necessarily have to be used by your business. It can be used by someone else's business. And so basically, most people just understand commercial property. So if we just think of commercial property, but I would mention as well, included in that definition is farmland. Now, farmland also has an important exemption, and it's the only one. So when we're dealing with commercial property, for example, some people want to run a B&B, which you can do, but you can't live in the B&B because you can never live in a property that's owned by the SMSF. Now, the one exemption is farmland. There's a carve out for farmers where you can live on up to 2 hectares. And Ashleigh may be aware, but 2 hectares is a big chunk of land. For those of us who aren't farmers, it's a lot of land. So there is a big carve out for farmers. Now, that is the only exemption. So where you've got a farm that you purchase in the SMSF, you are actually able to live on it. And if you think of it, 2 hectares is quite a lot. So you would be able to use that also for some personal purposes. So you'd be able to have, a pool, a garden, a dance party. You can do anything if you wanted to within that 2 hectares, but that's the only exemption. Now, other things to mention, it's very important to purchase the property that you are buying in the correct name, which means on the offer and acceptance, put the correct name on it. We go through this all the time. Reason being, if you put the wrong name, you may be up for double stamp duty. You cannot just put your own personal names and then go, oops, no, should have been the SMSF. You may be up for double stamp duty. So that is why if we know a client is purchasing property, which we are usually aware of because we spend a lot of time in the setup process saying, hey, what are you going to do? They tell us. Then we know they're purchasing property, and I will say, please send me the contract when you've written an offer acceptance, and I will have a look at the name. We want to avoid double stamp duty. Now, what may be problematic, if you have a loan, which we'll discuss in more detail in a minute, but if you have a loan, you can only have one title, one loan. Sometimes you may be purchasing, farmland's a good example. Sometimes a farm is on 4 titles. Sometimes you may be buying a property and it has a car park. So it's 2 titles. If you are involving a loan, that may be problematic. You can only have one title, one loan. You'd have to get 2 loans or 4 loans. Other things to mention, in an SMSF, you want to think about positive gearing. Negative gearing is not an environment for an SMSF. The tax rate is far too low to think about negative gearing. So you have to get out of the mentality of negative gearing. You want something positive geared. I always say to people, we want to look for properties where you're going to experience good capital growth, good capital gain, or very good rental yield, and ideally both. So that's what I'd be pitching to Ashleigh. Now, next thing to mention, there's this horrible thing in SMSFs called NALI and NALE. Someone who has nothing better to do than think up acronyms, thought up these horrible acronyms. So NALI, NALE. All you have to know, horrible. Just got to do with related parties doing things. ATO does not like a related party doing anything. From their point of view, if a related party is doing something, it's the SMSF is not getting taxed at a full tax rate because you are planning for your retirement. So the ATO does not want a related party doing anything because they're not getting taxed. So one of the big ones when we see property is people doing work on the property. So what might happen is a builder buys a property and goes, great, I'm going to do all this stuff. I'm going to put on an extension. I'm going to renovate the kitchen. I'm going to do all this work. Big problem there. So the builder hasn't done $50,000 worth of work and hasn't charged the SMSF, and the ATO do not like that. And they're going to come in and say that's NALE. NALE is non-arm's length expenditure. That hasn't been captured anywhere. Now, NALE, when it's a general expense, it's captured at 2 times the market value of the expenditure that was missed. But this is even worse. NALE, when it's related to a specific expense, is captured at basically, it taints that specific expense, which is tied to the income, it taints that forever. So you can never get rid of it. So it's taxed at the highest income rate, if you think about it. So the rent, which is the property rent, is taxed at the highest income rate. Okay. Forever. And you might think, oh, okay, all right. What about the capital gain? The capital gain is also taxed. So it's awful. Maybe the builder didn't do $45,000 worth of improvements. Maybe he just did a paint job. So it's awful. So you always want to be paying somebody to be doing any of the work. So for that reason, we want to rule out fixer-uppers and always pay someone else to do any of the work. So they're the kind of issues that we have, we've got to face. So we want a positive gear. We want to rule out fixer-uppers. We've got to involve other people to do the work. We've got to be careful of titles. And if we've got a commercial property, the other thing, we have to have a current lease at all times, because if we don't, and the lease expires or we don't have a current lease, it falls into the in-house asset rule, which basically means that it's got to be under 5% of the assets If not, we have to basically the ATO will make us dispose of that asset as well. So these are all very technical rules that I'm trying to make very simple, but they're all very bad. So we don't want to do any of these things. We want to look for properties. So this is why I tell my clients, basically look for properties that don't need a lot of work. So this would be my dream list if I have to make a list. I want a property that doesn't need a lot of work, good capital appreciation, and or high income yield. So that's what I'm looking for basically on one title. And then I'm going to go back to Ashleigh, but we are going to talk about also what you can and can't do with a loan. So I'm going to go back to Ashleigh now and ask her, does the information that I've just explained, would that help your buyers to make an informed decision about what kind of property to buy?
Yeah, definitely. And I'm finding, fortunately, like a lot of clients do get some good advice prior to making that decision because there is a process, like you said, with you setting it all up. So I find that generally they do come to a property manager educated already. And it's definitely exactly what you've said is in line with what they're buying. One thing that I would probably just remind clients about is don't rely on a property manager knowing that information. It's really, really important that you are getting that advice from someone like Susan, and so that because it is your responsibility. And I guess I just want to disclose that some people might think, oh, a property manager will tell me if I can or can't. Quite often they won't actually know. So definitely don't rely on that. And definitely exactly what you've said is exactly the perfect investment property.
Yeah, no, that's a good point. I mean, it's such a specialist area. Like, there's not even very many accountants who, would know the ins and outs in that area. So it is a big ask, to for for people to expect, like a property manager or a mortgage broker or a settlement agent, or anyone that they're dealing with. So that's why you really do need to talk to an SMSF expert before you do anything in that area. So yeah, I would encourage you to do that. So having discussed all of those things, I also want to ask Ashleigh, we're going to go through each of these individually. So in terms of investor tips, what tips would you have then in regards to, we've talked basically about we want either or, and ideally both. We want good capital growth and good income yield. So what tips would you have in terms of location?
Do you know everyone wants a bit of both? I always say to them like that. I also feel like that's quite a safe option. I feel like, high risk, high reward sometimes when it comes to capital growth and cash flow. Definitely, like I mentioned before, in the south where I'm seeing those clients buy are areas like Secret Harbour and Baldivis and Golden Bay. There's some beautiful little parts down that way, very popular. Going to the north, we've got a lot of activity happening in Alkimos and a lot of activity happening in Tapping as well. So definitely those two areas. I find that they probably go for those newer properties because they are more affordable than potentially an established property that's been renovated. So an established property that's been renovated, so it's in great condition, typically would be a little bit more expensive, I find, to actually purchase it. So that's why I'm not seeing a lot go down that road. I find it's a very personal opinion with, the cash flow and the capital growth. I guess that where I specialize in is the trending areas. So those areas are definitely trending. What's going to happen in the future in the Perth market? I feel like there's a lot of experts that still have really strong opinions on the growth. Definitely not seeing that growth like we did before, which in Perth, we've seen some areas anywhere between 55 and 90% growth in the last 3 years, which is incredible. You're not going to get that same growth, but there's still some pretty good, strong thoughts around us having a nice, consistent growth, regardless of where you buy. would say though that the highest cash flow properties we see are actually more inclined to be in those strata units, villas and townhouses, a little bit closer to the city. Definitely going to find that the cash flow and the rental yield is going to be higher in those ones, as opposed to the estates that you can build. And my only thought around that, and something just to keep in mind, is if you are buying in an area like Alkimos or Golden Bay, where there's a lot of building activity, it's all happening in an influx. So it's definitely a long-term plan, which self-managed super fund purchasing, I think, is in general anyway, but it's a long-term plan. So you will have to ride out a few cycles while there's such a big influx, I guess, of properties coming available for sale and for rent. Because at the end of the day, in some of these areas, they're all 4x2s. They all look the same. They're all the same age. They all are very, very similar. The only thing that you can actually differentiate them by is their price. So that's why we sometimes see in those areas that the rental price can drop, and then you have to compete your property against those. So that's what I sort of mean in the first 5 years of those purchases, and then just riding out that cycle. Long term, you'll probably be fine with it, but they're just little things to keep in mind that I notice, and yeah, what I'm seeing.
Yeah, no, that's great. And what about in terms of what our discussion in terms of the type of property? Do you have any tips in regards to that?
Well, I mean, 4x2s is really what you're finding everyone buying. I prefer a 4x2 than a 3x2. And I don't actually think I'm seeing many clients with 3x1s at the moment in the self-managed super fund space. They've all been that 4x2.
Do you have any comment in regards to buying apartments in terms of the fact that, like, obviously an apartment doesn't have any land, but apartments are still can be good in terms of a good income yield.
Yeah, totally. Well, that's where the high cash flow is going to come through. So and the lower capital growth. I think it just comes down to what are you actually needing? Are you wanting that cash flow into your account? Are you wanting that long-term capital growth to sell when you retire? It really just comes down to what you're wanting. When you're buying multiple properties, not in a self-managed super fund, but just building a portfolio in general, people are generally looking for one where they've got generally the first property they try to look for is the one that's got that high capital growth. That's their first purchase. Their second purchase tends to be one that is maybe a little bit safer in the capital growth, but it's going to have that good rental income. And then the third purchase might be something newer, or maybe that's the one in their self-managed super fund. So they actually do try to get a little bit of both in all of them. Like I said before, that playing safe is an area where you're going to get a little bit of both. Yeah. I really love seeing clients really take that risk for one or the other. So when it comes to apartments, my general rule is that anything that has a gym, a pool, and a lift is going to be very, very expensive. So while you can get that good cash flow growth, there will be a time where those strata levies are going to exceed. I know I've seen strata levies be more than what the owner's income is. So I'm not a huge fan of those. But what I do love is I love the villas. I love the townhouses. I love the groups of 4 or less in a complex, nice and easy to manage. And in the rental market currently, we are seeing the highest number of people attending those home opens to rent them. And the rental yields are amazing. I mean, to give you one very, very good example, probably the best case study I've had this year was a client who purchased a 2-bedroom unit and he paid $307,000 for it. It was in June, Dana, I think, so nice little spot there. We rented it out for $5.75 per week. So massive return, because there is just a demand for students, singles, professionals. There's a big diverse range of people that want those little tiny units. So they're super, super popular, excellent cash flow. But would you go and just buy all of them? No. Would they be a great option in a portfolio? Absolutely.
There's some great tips there from Ashleigh. And even just talking about, just diversifying even in terms of what you're choosing as far as your property. And another thing I just wanted to mention just occurred to me from what Ashleigh was talking about, in WA, there is lots of we're very spaced out within our state. And in the country, there's lots of property that you can buy very reasonably, still quite cheaply, very, very minimal capital growth, but geez, you can get some good rental returns from them.
And it's interesting because we've just had such a great couple of years with our rental yields where they were sort of up at that 6%. And now they've come back down to sort of like low fours, 4.3, 4.5%. And I think that that's, pretty crap, it's not as good as it was. And everyone reminds me, but Ash, they're still some of the best in the country. So in comparison to other areas, it's still very, very strong over here.
Yeah, exactly. Okay, well, we're going to finish off the formal part. I'm just going to run through some of the borrowing aspects in an SMSF. So if you've got any questions, just pop them in the question and answer box down at the bottom, and we'll answer your questions at the end. So as far as borrowing in an SMSF and how that affects what you can do with the property. So in an SMSF, you have to have, because of the way that the legislation is structured, when it came in, it was very political, and they basically didn't want to allow SMSFs to borrow. So they did it in a very structured way. And because of that, we have what's called limited borrowing recourse arrangements, which is LRBAs. So the legislation is very specific, and it is very technical and quite complex. But basically, to put it very simply, when you have an LRBA, you can only borrow against what's called a single acquirable asset. So each loan is only against one asset, and the lender only has recourse to that one specific asset in the SMSF. So for example, if you've got cash and other assets, if you default on that loan, the lender can only come after that one specific asset. So that's why when we talk about titles, if you are purchasing a property and there's more than one title, the lender can only give you a loan against that one title. So you would actually have to get two loans. Now, the way that it's set up, we set all our clients up initially. There is a special purpose company which acts as a trustee for the SMSF. The SMSF is set up according to a trust deed. Then when you have a loan in place, you have another company, which is a PTY Ltd company, and that acts as trustee, and you have a bare trust. And the bare trust holds the property on trust for the SMSF until the loan is completely paid off. And that is for the specific reason so that the lender will only be able to go after that one specific asset, which is basically the property. Now, the other thing that's important to note is that whilst the loan is in place, you cannot change the nature of the asset. So you couldn't do a capital, for example, a property development with a loan in place because you cannot change the nature of that asset. So, for example, if you wanted to knock down, an existing building and build a block of units, you can't do anything like that with a loan in place. Also, you couldn't do significant capital improvements because you would be defaulting on the loan, because the loan will say you cannot change the nature of the asset while the loan is in place. So you have to consider whilst the loan is in place, anything that you were doing that may default on that loan. So you have to consider carefully when you're doing things, say in the kitchen, you know, if you want to replace things, you have to consider, is what you're doing a repair and maintenance, or are you doing a capital improvement? You have to consider those things very carefully so as not to breach the SIS Act, the super laws, and also so to not to default on your loan, which is very important, very serious consequences. So yeah, that's basically in a nutshell, put very simply, the rules around borrowing. So that does also change what we can and can't do. And also, that's as far as a loan goes. Now, if you don't have a loan in place, yeah, you can do all those things. You can, you could buy something, knock it down, and, build a completely new building. You could do capital, you can do all of those things, but you can't do it with borrowed money, and you can only do it with the SMSF's own money, and you can't do it with a loan in place. Now, the last thing I wanted to mention, of course, very important, is the taxing of an SMSF. Now, why do people want to get property into an SMSF? Well, the main reason is because it is the lowest taxed entity that we have. So in exchange for basically, having your SMSF regulated by the ATO, it gives you a whole bunch of tax concessions, and they are very, very low. Company tax rate, 30% or 25%. You've got a family trust, but you still have to distribute, of course, and the beneficiaries will pay at their marginal tax rate. You've got individual tax rates, but a SMSF is still the entity with the lowest tax rate. So when you're first putting your money in an SMSF and you're in accumulation phase, you pay tax at 15%, which is incredibly low. If you hold on to your property for more than a year, you will pay tax on a capital gain at 10% because you get a 30% discount. So 10% is nothing. It's so low. Now, if you hold on to that property until I, as in an SMSF expert, can get you into pension phase, it is tax-free. So it's all tax-free. So I've had clients who've made $1 million capital gain and it's all tax-free. And there's no other entity that you can do that in. So that is why people want property in an SMSF. Now, we do have legislation at the moment. We're trying to put a cap on $3 million per person, which means husband and wife would have a $6 million. But that hasn't come in yet. So that's the only kind of limit I'd say there may be going into the future. But it's still an incredible tax environment to have property in. So that is why people basically want property in their SMSF. Now, there are things that you want an SMSF expert for. You want to basically estate plan. What are you going to do with that property down the track? So you want someone like myself involved. But as far as a concessional tax environment, it's unbeatable. So there are things we do have to deal with, but yeah, you just want to involve someone like myself. So that's basically the content that we had to get through today. Was there anything else that you wanted to add, Ashleigh?
No, I think you've done a great job at explaining it all. I've learned some stuff.
Oh, good. All right. Well, I try my best. I try not to get too complex and complicated. Try and break it all down. So we've got a couple of questions. So yeah, if anyone else has got any questions, just pop them in the chat. So the first one is, how quickly can I set up an SMSF to purchase property? So now we do tell our clients to allow 6 to 8 weeks to set up an SMSF. Now, I always say the part that we do as an SMSF firm, we do very quickly and efficiently. But unfortunately, we have two third parties involved in the process, and that's what slows us down. So I'm a licensed accountant. There's very few of us. I'm a bit of a unicorn in that I'm also self-licensed. So I don't believe there's another self-licensed accountant in Perth. I have a license to advise in SMSFs, which you are supposed to receive advice before you set up an SMSF. There are still accountants out there setting up SMSFs without providing advice, but it's actually illegal to do so. And also, any of the ones who are licensed are usually licensed under a dealer group. What does that mean? That means that they are licensed under a group, a licensee, which means that, you know, they usually will do the investment advice, which means they're selling products, basically, financial products to you to invest in. I don't do any of that. I don't have anything to sell you. I don't have any financial interest in you investing in anything, which is why we can say we're truly independent. So we just guide you around your investment choices. Self-managed, in my opinion, should be truly self-managed, self-guided, and then we just assist you through the compliance aspects and provide you all the advice, all the strategies. What you should be paying a expert for is the strategies, but yeah, not paying them to invest in their financial products. Anyway, that's my soapbox. So 6 to 8 weeks. Now, two components in there. One, when we provide our initial financial advice, we write to your existing superannuation fund and we ask them for your information so that we can do a comparison. We provide you with detailed comparison. This is what your existing superannuation is doing. This is what an SMSF will do, so you can make an informed choice. They are slow at providing us that information. So that's hold up number one. When the SMSF is set up, the ATO puts you onto Superfund Lookup, and you need to be on Superfund Lookup to do a number of things. One is set up a bank account. Two is rollover. Now, the ATO's guidance is it can take between 2 and 56 days, which is a very wide time frame. So all of the ones that we've done lately has been within about 3 or 4 days, but every now and then they will pull someone out of the system, manually review it, and it can take 28 days. So if that happens, the time does blow out. Now, the next hold up, and this is something that we've been finding very frustrating lately, is when you go to roll over. When we had the old system, we used to fill out a manual form. The client would fill out a manual form, send it to the super fund and say, I want to roll over my 200,000 into my SMSF, and the superannuation fund would drag their heels and not give us the money because they wanted to keep the money as long as possible. And then the government passed legislation and said, no, that's not good enough. You've been dragging your heels. And so we're going to set up this super stream system, which is all electronic. And within 3 days, 3 business days, you must process the rollover. Sounds good in theory. Now what happens is they just do all that dragging their heels at the front of the system where they go, we want to go through all these identity checks. So we're going to waste 2 weeks not telling you what the identity checks are, but just making you jump through all these hoops. We won't list them anywhere or tell you what they are, but we're going to take 2 weeks asking you for identity checks. So 8 weeks, I would allow at an absolute minimum to set up an SMSF. Now, the 8 weeks will get you it set up, rolled over, your money's in the fund, you're good to go. Now you can write an offer and acceptance. Bear in mind, if you're trying to get a loan and everything, you need to allow a bit of time for that as well, because you're going to have to get the loan in place. But we generally get clients doing that concurrently, so they've got the loan approval and they've got it all good to go. So hopefully that's answered that question. Yes, this is another great question. Can I sign the contract before the SMSF is finished setting up? No, please don't do that. So we get asked that all the time. So most dangerous thing you can ever do is go property shopping before your SMSF is set up, and get your heart set on a specific property that you want to buy, and then you want to write out an offer and acceptance, especially where there's a loan involved. You cannot write an offer and acceptance before the entities are set up. The reason is that the entities have to be set up properly. What will happen is you will write out an offer and acceptance. The settlement agent and their lawyers will do a due diligence. They will check, as part of that process, what date the entities were set up. And if the offer and acceptance was signed prior to those entities being set up, you will be in the doo-doo, to put it nicely. Now, the other thing is, if you try and sign the offer and acceptance, say, in your personal names, and then you go, oh, don't worry about it, I'll sign it in my personal names, and then when the entities are set up, I will change it into the correct names, you're also fraught with difficulty, because you may be up for double stamp duty. So we always advise people not to do that. Now, I do find that clients are pressured unnecessarily by real estate agents to sign an offer and acceptance, and told, yeah, don't worry, it'll be fine, it'll be fine. Yeah, don't do that. I cannot guarantee that we will be able to get you out of paying double stamp duty. Yeah, you need to wait until the entities are set up.
Can I just quickly add on to that, Susan? Also, just on that, don't rely on the real estate agent to know what entity to write your
Exactly. Yes.
because they actually don't know.
They don't know. No.
Even if they think they do, they don't. Please make sure that you get Susan's advice on what it needs to read.
We tell client, because if it's, say it's the super fund, it needs to be written out the company as trustee for the super fund. Say it's the bare trust, say it's in a loan, it needs to be set out as the holding company as trustee for the bare trust, as trustee for the special purpose company, as trustee for the super fund. But we give people the exact wording. So that's the kind of SMSF specialist you need to be working for, who you can actually say, what do I put on the contract? Yes. So, I mean, it's not up to the real estate agent to tell you that. So, yeah. Okay. So I've done that one. And I've got a question here. Can you offer a health check of my SMSF to ensure it was set up correctly and is compliant? So yeah, if you want to send us an email, we'd be happy to look over your SMSF for you. Susan@o'connoraccounting.com.au. So thank you. Yeah, so they were great questions. Thank you very much, everybody, for sending those questions. Yeah, so we're perfectly on time. Yay. I love to be on time. So thank you so much for joining us today. As I said, we're going to have series of webinars. We're going to continue on and do a whole lot of different investment options. So if you want to join us for those, best way to do that, if you go to www.susanoconnoraccounting.com.au, if you scroll down, there's a place where you can subscribe to our newsletter. That's the best way to keep in contact with us. If you have any questions, comments, feedback for me, you can send me an email, susan@o'connoraccounting.com.au. I do have an ebook that I've written on everything to do with SMSFs, which is on the website. That's $15.50. We do have these girls just want to have funds. Tote bags, which are going to be for sale. I think they'll be $18 plus postage, or you can pick them up. So they'll be coming. If you want one of those, you can just email us as well. And I'm going to go over. Oh, you can follow me on Facebook, LinkedIn, Instagram. Yeah. And I'm going to go over to Ashleigh and see. Ashleigh, can you let us know how can people get in contact with you? How can they follow you? How can they find you?
Yeah, so I'm on all the usuals, the LinkedIn, Instagram, Facebook, and TikTok. I also have a lot on my YouTube channel, which is Perth Property Managers. So if you do like self-education, you might like going through and seeing some interviews I've done and some extra education there. And just while SoCo Realty does also do property management, I also do a lot of investor support services prior under property profiling. So if you're looking at buying something, but you really just don't know what area to buy in, or what you can afford with your budget, you can definitely contact me. Normally I just recommend that you've got your pre-approval first, so you know your budget, then contact me, and I'm happy to sit and do a half-hour Zoom with you to go through maybe a bit of a plan, so you've got a plan when it comes to searching. Otherwise it'd be very overwhelming. So feel free just to reach out through any platforms to book that in.
Okay, thank you so much. Thank you, Ashleigh. I really do appreciate you being on the webinar today. And thank you, everyone, for joining us. And we'll catch you next time. Thank you. Bye.